When the stock market is going down, which happens occasionally, you get to rebalance. It gives you the opportunity to buy stocks at a low price.
Funny you said that. Let's pull up some studies.
Oh, you mean, Dave, we have data?
We got data. If you use an advisor and they say we're going to use individual bonds, ask them what research team they use. If they say it's me and my secretary, then you're like, actually, I want bond funds.
This is a really cool story.
So she had bought a 30-year bond when interest rates were close to 10%. And now we're looking at interest rates being 3%, and she's like, I am never selling this.
Asset location and asset allocation really matter. And depending on where you're putting your bonds in your portfolio, then depends on maybe what type of bonds you're buying. This is like how a chef is, but we are a chef like cooking in an investment kitchen. And that's really important for retirees because
when we talk about investing, we together talk about diversification. That is stocks and bonds. What does that even mean? We're going to drill down into why bonds are a little bit different than stocks. We're going to take you through diversification, what it actually means, and you're going to be well educated after this episode. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. If you've never been to our podcast before, welcome. We break our podcast into a number of sections. We talk about content and we dive into it. We then answer questions and then we tell you bits about ourselves personally and professionally, whether you want to hear them or not. Today, we're talking about bonds specifically as we talk about investing. So sit back, relax, and let's dive in. All right, so we're jumping into what are we talking about? So let's figure out exactly what a bond is. So a bond, you're making a loan to a company or the government. You're giving them money. In return, they're going to pay you interest for a set period of time, and at the end, they're giving you your money back. It's kind of just like that. So it can work. You give your money to the bank. They give you a CD term. It's a year. They'll pay you interest for the year, and then at the end, they give you your money back. It's different than a stock. Take us through that.
it's different than a stock because normally it's not as volatile, right? It's the way we stabilize portfolios. And if you hold these bonds until maturity, right, which means the full time of the loan, let's put it, the interest payment happens, right? As long as the company or the government doesn't go default, right? You get that interest. It's very predictable. What happens though, not to like complicate things, is it can be the stock market is sometimes people are buying bonds from another person, like, hey, you have an AbbVie, I know you love that company, corporate bond, and you don't want any more, and I'll buy it for you at this price, right? So that can kind of change prices of bonds that people see.
Okay.
But if you hold it to maturity, you lock in an interest rate and you lock in how much you're going to earn over that time. And stocks, why they're so different is you're investing in growth in a company. That is very different. A loan versus growth are two entirely separate things.
Yeah. All right. So if I'm going to go out there and I want to build my own investment portfolio, and I am saying, okay, I'm going to go pick some stocks and pick some bonds, is it that easy?
I mean, of course it's that easy. No. I mean, we could rattle off how many different types of bonds are there too, right? You got the government bonds, the U.S. government bonds, those are Treasury. We got international bonds. We have corporate bonds where you're loaning to companies. We have municipal bonds, which are city bonds, right? What am I missing here? We have mortgage-backed security bonds that basically made this global financial crisis happen, right? I'm missing some. I must be.
The rest of the world has bonds in every different country and company.
Yeah. Like there's tons of bonds. So, I wouldn't say it's that simple. In my client portfolios, I have US, international, and some corporate, right? I believe that not just in bonds, you also diversify among bonds. It's not like, oh, let's just do all treasuries or let's just buy one big giant corporate bond to Google or something. No, it's more complicated than that because bonds, they're not sexy. They can be, I guess, but not really.
I like them.
You like?
Yeah, I dress them up.
You dress them up. Okay. They got heels. But they are so important in a portfolio because of stabilization. And they are probably the most important for people that are living off their portfolio. Like, I would say they're non-optional in a retiree or a person living off their portfolio and financial freedom.
Yeah.
And we'll get into that. Someone probably in their 20s shouldn't have bonds unless it's a short-term goal, right? Like they are there to minimize volatility, but there's also another very important key factor of them is when the stock market is going down, which happens occasionally, you get to rebalance. It gives you the opportunity to buy stocks at a low price.
By selling your bonds.
By selling your bonds that normally stay pretty stable. They don't, let's say the stock market goes down 30, maybe bonds go down 5%. Let's just say, right? So you get to buy stocks at a big discount. It's amazing.
Yeah. All right. So now we're talking about rebalancing. Let's kind of shift into, okay, well, there's different approaches for stocks. There's different approaches for bonds. I can hire someone to kind of pick companies for me, or I can just invest in an index. Is that the same for bonds as well as it is for stocks?
So for a long time, I had my clients in bond index funds, right? And then I studied more and I studied more and more data came out. And I actually found in some cases, active managers, so people trying to outperform just a regular index, just buying a bond index, active managers choosing which bonds they're buying actually outperform and are less volatile. That was important to me. Like the drawdown is less in a downturn than just an index fund.
Okay.
I was shocked. Now, of course, there's no blanket. We'll pull up this chart eventually, but tips, which I have some of my clients in. So those are inflation protected, Treasury, inflation protected securities. Did I get that right? Yeah. So that's basically like, hey, if the US inflation goes up 3%, it goes up 3%, right? And that's really important for retirees because inflation is one of their biggest killers of their portfolio. So I do have a portion of my bond or fixed income portion of my portfolio in tips, but those passive is like active managers do not outperform at all. It is like not even a point.
Okay.
So you have to kind of drill down into the type of bond. Now our listeners are like, what the fluff are they talking about? But you have to drill down into the type of bond. This is not just a blanket thing. And why we're going into so much detail here is, again, Dave and I deal with people that are living off of their portfolios. And what is, in our past podcast episodes, what have we talked about? People's biggest fear is running out of money, right? And so bonds play that really important role in times of market downturn that we stabilize a portfolio. So this is something we have to pay a lot of attention to. And when you talk about passive and active, I don't really even bother. Like the data is too strong. Active managers, meaning people trying to outperform the stock market, it's very, very rare that they do consistently.
Funny you said that. Let's pull up some studies.
Oh, you mean, Dave, we have data?
We got data. All right, first one. This is going to back up your point because I found some stuff that doesn't back up your point.
Well, I am definitely ready to go and tell you why. Okay, let's go.
All right, so Guggenheim ran a study. They showed that actively managed bond funds have historically outperformed their passive bond benchmarks. Lots of jargon there. That just means that bond managers who are running a bond fund, they have to tie their fund to a certain index, which is going to be the generic US bond market, for example. They have found that they historically perform better than a generic index does. And that's because they can be flexible. Interest rates change. Funnily enough, there's reports that show the exact opposite to that. Morningstar showed that 42% of active bond managers beat their passive peers over the past decade. That's not over 50%.
So I'm not surprised by that because the chart that I show, right, where it's showing, which of the asset classes, which active managers more are likely to outperform than not, right? Less likely. What's interesting is it depends on what type of bond, right? Like tips you're talking about, don't even bother, right? Just go index. But you go down, short-term bonds is the first one that is saying that active managers are more likely to outperform. So, you have the broad spectrum on each side. So I think it depends on what type of bond you are buying.
Sure.
And when I did this, I mean, it took a lot for me to change my portfolio for my clients. And it does depend on what is the duration. So that means for our listeners, okay, short-term bonds are probably 1 to 3 years, you'd say, is how long the loan is for. But some bonds, I mean, can't they go all the way to 30 years? So that's like, that would be a long-term bond, right? So it really depends on how long the duration of these bonds are that you are. And it makes sense that the 1 to 3 years short-term bonds, active managers can outperform because it's a short period. You kind of know where the economy is. So you're like, the Federal Reserve is going to increase interest rates or lower interest rates. And not to even lose our listeners now, but let's say you loan me something at 4%, but now the Fed just raised interest rates to 5%. Well, now your 4% bond isn't as valuable. I want the 5%, right?
Sure.
So,
I'll sell you mine at a discount though, just to take it off my hands.
So like that's how you decrease. And so, but there is this predictive nature in some way. Like you can predict much easier with bonds in the short term than you can the stock market. That's it. When you look at this, it makes sense once you know how bonds work, why.
Sure. Let me give you a story really quick to kind of illustrate that. The first financial planning office I worked at, we had probably an 80-year-old woman come into the office, and she had 3 holdings in her portfolio. She had a 30-year bond, and she had bought it when interest rates were all-time highs in the mortgage market. And it was, I don't know what they were, like 18%? Like way back in the...
This is a really cool story.
So she had bought a 30-year bond when interest rates were close to 10%.
So her bond had a 10%.
She had a fixed 10% interest rate for 30 years. All the while, interest rates just went down and down and down. And now we're looking at interest rates of being 3, and she's like, I am never selling this.
No, I would agree with her.
Yeah, I don't blame you.
No.
And so if interest rates are high, you want to buy that longer term bond to lock in that rate. If interest rates are bouncing around or really low, you don't want to play with a long-term bond because chances are you might lose some money there.
Oh my gosh. If her 30-year, like, you wouldn't sell that. That's a guaranteed 10% return for not very much risk.
Sure. It's just holding that thing and it's kicking off a ton of income.
So listeners, and something why you have financial advisors like us, if interest rates ever go that high, I will be locking in some long-term bonds. That's when I will probably get out of bond funds and I would start buying individual bonds. Wouldn't you?
I have done something similar.
Okay.
So when COVID was bouncing around and interest rates were kind of flopping all over the place, for my clients who had withdrawals coming for the next 3 years, I then told them, okay, interest rates are predicting like they're going to drop. Like that's the word on the street. Let's lock in CD rates now for the next 3 years.
Done that, yeah.
And, they were between 5 and 6% at that point. Now we're at 3. And so now they're looking at me like, are you like a magician? I'm like, no, that's just how the bond game works. If you can lock in a rate that is you like and is preferential for you for the longest period of time that you're comfortable with, do it.
Yeah. And I also want to state and stop halfway through. Listeners, this is not your ordinary podcast, and I'm going to keep saying this every time. We go beyond Finance 101. I think Finance 101 has been done very well. Dave and I are diving into the details that aren't talked very much about. This is what happens behind the curtain, and we want to share it with you.
Mm-hmm.
Okay, so how do you feel? Are you more active or passive for bonds? Outperform by choosing people that are trying to outperform the market in bonds, or just be the index?
I am the index all day.
Okay.
Does that mean I might underperform? Sure. But that's not where I'm going for performance. My performance is in equities.
I mean, that's where we need it. Yes. Yeah. I'm 40% passive, 60% active in bonds. And that was a switch I made last year. And it was a very big switch.
I'm sure it was.
Yes.
All right. So now we're talking about, yes, that's the approach with bonds. How do you then build it into a portfolio when someone is trying to build this themselves? Like that, it's complex, but there's some certain rules you have to follow with asset allocation and asset location.
So let's define those really quick. Asset location is where are you putting your investments among your accounts? Because if you've listened to our podcast, you don't just have one type of investment account. You have diversified among the different types of accounts for tax efficiency. and diversification. And 2, what was it? Asset location. And what was the other one?
Allocation.
Allocation. When we're talking about asset allocation, that's how much do you have in stocks versus how much do you have in bonds? And that can be risk tolerance. That can depend on your goals. There are many factors that go into that. Obviously, the younger you are, I mean, my clients that have kids, they have no fluffing bonds in their portfolio. Like that is ridiculous. Like 100% stocks all the way. I don't even really give my clients an option. I mean, they normally agree with me, but I just send the investment policy. I'm like 100% stocks. Like this is what we're doing.
Does that include you too? Do you have any bonds?
I do.
Okay.
Not, what you mean for my kids?
No, in your overall allocation, do you have any bonds in your portfolio?
I do. And this comes back to the asset location where I'm putting them. We only have them in me and Alex's 401k. So where we will pay pre-tax dollars when we pull out, as that's where I don't want as much growth. So my Roths are 100% stock. And then our brokerage was 100% stock. And on a previous episode I shared, we added 10% of muni bonds because I do need some more stability in there, because we will eventually probably use our brokerage to buy our next house, because I'll probably buy it and then just go and sell our second house. So I'll need some stability in our brokerage account.
Stability.
I never can say the words.
I was waiting till you said it again. I'm like, I can't correct her on the first time.
So just keep, I mean.
Yes, I get it.
Yeah. So how about you? Where are your bonds?
Well, we've gone 80-20 asset allocation.
You're more conservative. Okay.
Got a huge pension coming. I don't need to shoot for the home runs all the time.
Oh, you poor thing.
This is me crossing my fingers that something doesn't happen, that we break up.
Why would you put that out there at this point?
You got to put everything in the universe.
Yeah. Okay.
And then it'll bring it all back to you, whichever's right.
Sarah. No, I think you guys are pretty
So I think we have an 80-20 allocation. Our bonds are in retirement accounts. Like there's...
Not in Roth, though.
I know. Don't think so. Not the last time I checked.
You see, you have to do what I do. You have to go review your asset allocation. Now that's your homework. I'm going to ask you.
I need to caveat this. Like the last time I looked, they weren't there, but who knows? Yeah. So yeah, it's very tax efficient in the fact that all of our bonds are in IRAs and 401ks.
So let's actually talk about that really quick, because there is this term tax drag that's used a lot, and I see it, I believe in it. So that's basically meaning your investments aren't tax efficient. And so because you're paying taxes on them, it actually brings down your return. Did I explain that, Eli 5? Okay. So bonds give off interest income. And interest income is actually taxed at ordinary income tax rate, so the highest tax rate. So
ordinary income rates being your tax brackets.
Yes. So it's taxed the same way as if you have a W-2, right? Income or business income, right? So in my clients' brokerage accounts, I use municipal bonds. And why municipal bonds? So those are the city bonds. So you're loaning to city projects and cities, right? Interestingly enough, the Fed does not tax that interest income. So you're making interest and paying 0% tax on them. Now, I don't like my entire client's portfolio to just have muni bonds, municipal bonds. But in my clients' brokerage accounts, i.e. they're not in retirement accounts, I use muni bonds. Not to go really down the rabbit hole. States can have different rules. So, but I don't know. Normally people's federal tax bracket is way higher than the state bracket.
It is.
So that's me getting into, but this is where like asset location and asset allocation really matter. And depending on where you're putting your bonds in your portfolio, then depends on maybe what type of bonds you're buying. This is like how a chef is, but we are a chef like cooking in an investment kitchen.
Yeah, if you can't see us properly right now, we're squirming because we are trying not to dive off into the deep end of this conversation.
I'm trying so hard.
Because we could be here for a couple hours just like talking about the little minute things that we do. And we're not here for that. Yeah,
I do think though, how do you determine, because I think it's interesting for people to listen, how do you determine how much bonds someone should be in their portfolio?
There's a number of different things. I mean, one, because we have to, I give people a questionnaire that's based on their risk and their goals and give them a risk profile. That is mainly for compliance.
That sounded so boring. That was really boring.
So I do the questionnaire, and then we have a conversation. Like, how much risk do you like taking? I kind of frame that in different ways. Because if you ask someone how much risk they like taking, they're like, huh? What? So then we start talking about, like, what do you do on vacation? Like, do you sit at the beach or do you go on a helicopter ride? And some of these questions are like, I love the helicopter rides. I'm like, all right, higher risk. And people are like, yeah, I don't like to do much. Like, I don't like to have adventures. I'm like, maybe that's a lower risk person. So all these kind of conversations there, kind of framing what type of person they are, what type of risk they like to take, what investments eventually are going to be appropriate. And then we're looking at, well, what is the financial plan trying to achieve? Do they have a long amount of runway that they need a lot of returns in order to get to these goals, meaning they need to take a lot more risk? Or do they have a lot of money and they don't need to take a lot of risk? So all of these things come into it. And then at the end of the day, I'm explaining it to these people. And I'm saying, this is your best case scenario in terms of returns on an annual basis. This is what happens if we go through 2008 again. And then I look at their face. And if they can look at that portfolio and say, oh, it drops 25%. How long does it take to go back up again? I'm like, okay, you could stomach that. If they then say, that's 30%, does that come back? I'm like, all right, maybe that's too much. And so all of those conversations go into determining what allocation is appropriate. A lot of my clients have a lot of income outside their portfolio. So then I explain to them, you have no wrong or right answer. You can take a ton of risk. You can take a minimal risk. It doesn't affect your situation. What would you like to do? The majority take less risk.
Interesting. I would think your clients, yes, your clients are less risky. I feel like my clients are the helicopter riders. We have very different clientele. I would say too, generally, young and even under 30s, most of my clients are 90-10, even through 30s. I'm 90-10. Nearing 40s, closer to 50s, we're starting to go down to 80-20. I'm starting to take some chips off the table. Once they're within 5 years of retirement, we are really looking at how the buckets and starting to build those and craft it to exactly what they need and how much.
Sure.
What's my favorite word? Stability? Did I say it right?
Way to go.
Okay, I heard you say it. That's why. They need in their portfolio, right? That's what I would do. But what I think is really sad is when you see, I've seen this, like a 30-year-old woman come into my office and she has a 50-50 portfolio. And she needs growth.
Yeah.
Like that's the other side of it. And okay, I might get in trouble with my compliance officer for saying this. I literally do the risk tolerance questionnaire, those stupid questionnaires that your financial advisor gives you, because I'm required to.
Okay, that's not getting in trouble.
Like, they don't actually do a good job, because what it does tell me though is maybe if they need more education. So I'll see like how they answer, where their fears can be, because that can do it, and then I educate them. But I do not like use that and go, oh, they don't have a lot of risk, but so I'm going to put them in 50% bonds. If their plan says that just fails the plan, I'm going to like get them comfortable to take more risk.
Sure.
And I think even Kitsis, someone in our industry that is extremely intelligent that we learn a lot from, he even did a whole article about how useless risk tolerance questionnaires are. It's like, no, you know. Okay, we'll end there.
So I think when you were talking about buckets, it is interesting when you are building a regular portfolio while you're working. It can be simple. You pick an allocation, you figure out what the accounts are, and you kind of piecemeal the investments in there. Once you get closer to retirement, that doesn't matter as much, because now you're designing a retirement income plan, which is different. And that's where I see people get in trouble, because they'll take that simple allocation that they built all the way through their career, not change it, not make any adjustments, and think that that's okay going into retirement, and that will serve their needs. And it doesn't, because now they're starting to trigger taxes that they didn't need to do. They could have designed this slightly differently a couple of years before and avoided that. Or they get into a position where the stock market starts to trip and fall and their portfolio does the same thing, and it's not what they need in retirement. So whenever I see people who have built a portfolio and they're nearing retirement and they haven't changed anything, and they come into my office, that's my sign to say, we need to talk about this because you're setting yourself up for a fall if we don't change it.
Yeah. I think that is enough down the rabbit hole for now of bonds.
I got 4 hours still. Let's keep going.
Well, we could, but we're not going to do that. Here's where I'm going to wrap it up. Stocks and bonds are completely different. They serve very different roles in a portfolio. And I think that that is very, very important to understand. You also need to know how much bonds you should have in your portfolio based on your goals. And not to complicate things more, but it's important, make sure your bonds are in the right locations for tax efficiency. And if you are retired and living off your portfolio, make sure you have enough. That's what I would do.
Nice. All right. Wake up. That was deep. But now we're moving on to a different section of our podcast. Before we do that, I do need a favor. If you've been here before, throw us a like, comment, subscribe, follow, and send it to your next door neighbor. Your mom got it last time. Your next door neighbor needs to hear this one. If you have not been here before, you don't need to do anything. Just sit back, relax, come back for another episode because they're very different. See if you like it. We are moving into the next section of our podcast. It is the question section. It is called, What Would You Do?
Question 1. Should I be using individual bonds or bond funds in my portfolio?
No. Question number 2. I love those questions.
No. Yeah, I'd have to say no.
All right. If you're running your own portfolio, do not use individual bonds. There's so many variables and things that you have to educate yourself on that chances are you might not understand and you'll get yourself in trouble. So use bond funds.
Like credit risk. Let me give you an example. One of my clients had many corporate bonds.
Mm-hmm.
And then I would get these alerts like, oh, it got downgraded in its grade. Bonds are graded based on how likely they are to pay you back. And I'm like, oh, this makes me way too nervous.
Mm-hmm.
Like, you're going to be in this one company and no.
Option number 2, if you use an advisor and they say we're going to use individual bonds, ask them what research team they use. And if they say it's me and my secretary, then you're like, actually, I want bond funds.
Mm-hmm.
If they say we've got a team of 8 dedicated on the research desk, you're like, okay, that's fine. Other than this, no, bond funds all the way. Question number 2. I'm currently using the bucket approach to fund my retirement income. How do I approach using bonds in this scenario?
Fantastic. I wonder if they heard our podcast. What do you think?
We've never talked about buckets before. Come closer. Let me tell you about buckets.
Buckets. I do love the buckets. Never. All right. So if you are using the buckets approach, Dave and I apparently have a love affair for the bucket approach. Where I build my buckets is I put bonds and cash, because remember you need both, in the accounts where I know I will be distributing from for the next 3 to 5 years, let's say, depending on your runway. And so that is how I put them. If I'm not touching my client's Roth, I don't expect to touch it for 10 years. That's my plan. There is no cash or bonds in the Roth account. That's like the best example I can give.
Okay.
I would say that really, though, my bond funds are mostly held in my client's pre-tax accounts is where I keep them.
Mm-hmm.
How about you?
It's going to be different if I'm using buckets. So if I've got someone who's got, because I'm talking about Roth conversions with people here as well. So I don't necessarily care if the bonds are there or the bonds are not there. But if I'm having someone take their annual income from a non-retirement account, so a taxable account, I'm going to have bonds in there because I'm having that runway of income. So if some of it's going to be cash, some might be in a CD, some might be short-term. Depending on their tax bracket, it might be a tax-exempt bond. Very individual, but there could be a runway in a non-retirement account there.
Yeah, one of my clients, again, this is like back to personal financial planning. One of my clients actually doesn't have enough in pre-tax. Their brokerage is like the taxable account is the heaviest one of all of them.
Yep.
So I have to put bonds in there. I can't get out of it. So it kind of depends on your asset, your account levels in each account. It's very personalized.
Mm-hmm. Agreed.
Okay. In 2008, bonds weren't a diversifier and moved in lockstep with equities. What data is this person reading? Okay. How do I know this won't happen again and give this? Should I adjust my approach to bonds? I did my own research on this.
You did. This is a good question
It is a good question.
because I do get this a lot from
You
people
do?
coming in. Yeah.
Oh, I've never gotten this.
Because people say, well, how does this portfolio work in a downturn? And they're specifically referring to 2008.
It was scary.
It was. So I think when you're building a portfolio, you can't look at one market event that's going to determine your portfolio design. Because a portfolio in 2008 acted differently in 2000. They trended in the same direction. They both went down, but there was different triggers. 2008 was, and we're going to get nerdy, a systematic event, which means that the stock market and the bond market failed. There was people taking advantage of it and doing things that weren't right and fair that caused things to fail. There's a lot of regulatory things that have gone into place which will now stop that. So for one, naked short selling. It's not an inappropriate term. It means that you don't hold a stock and then you short it. You can't do that anymore. It's illegal.
I've never even heard of that term.
Naked short selling?
Yeah, I don't know what that is because I guess because it's illegal, I've never had to research it.
So that is when people didn't own bank stocks and they shorted them knowing that they were going to go down. And that's why bank stocks stopped trading because there was so many naked short sellers. And as soon as they turned it on, bank stock plummeted because they all rebought their positions. And now that's why it's illegal. So that's something that's can't say never. That's something that will likely never happen again because it's now illegal and you can't do that. So that's going to be a stopgap in the market that's not going to make that happen again in your portfolio. What did your research tell you?
It depended on what type of bond it was. Like mortgage-backed securities, I mean, the housing crisis fell. So those did absolutely horrible. But treasuries, actually, they did their job. Treasury bonds held. So this is going back to what we talked about is it's not just blindly owning bonds. It's what type of bonds do you have in your portfolio? And this is why, I diversify among the type of bonds that my clients have. I don't just have U.S. bonds. I have some international bonds and I have some corporate bonds in there.
Nice.
But I think it was 2002. Don't quote me, but even if you look, if the stock market goes down, corporate bonds do get hurt because it's correlated, right? Like you're investing in the companies. So again, diversification.
All right, end of the questions. We're now going into our section called highlights. Your highlight has 3 exclamation points to it. So I think you need to lead off.
All right. I'm even nervous to share this, but my best friend, and this best friend, so you understand, is, she is the one that will take my kids if something happens to me. She's the financial power of attorney and trustee.
Yeah.
This is my best friend, okay? She's having twins.
Oh, you're samesies.
My best friend is also having twins. So when she called and told me, by the way, I knew she was pregnant, but she waited the full 3 months to tell me she was pregnant with twins.
Okay.
So then I find out that she's not just pregnant, she's pregnant with twins. So I'm on the phone with her and she literally thought I hung up the phone or something happened because I just didn't speak, which, me not speaking is very unusual.
Very rare.
Yes.
Yep.
I just started crying with joy. Alex was driving the car and I'm just crying and she's like, "Are you there?" And I'm like, I can't speak. And she's having a boy and a girl.
Oh, cool.
So I have 2 girls. She's going to have a boy and a girl. And it's just unreal. It's just I can't believe we're going through this together. It's really, really cool.
So you're going to tell her all the things not to do and the things to do with twins?
Oh yeah, we've already really dove into that. I made her baby shower list and all the things.
Awesome.
Yeah, it's really cool. But I'm just what are the fluffing chances? She wanted twins. And it must be twin energy between us.
All right. So for my update, we're in spring. This is not a personal update. This is professional. So we're in spring, which is tax season, which already has some of my clients edgy, a little nervous. What do I need to do? When do I need to get it to you? I'm like, pump the brakes. Not yet.
Not yet. It's too early.
We've got time.
Yeah.
It's 4 months of the start of the year that we'll get to this. And then in my spring season, that's when a lot of my executive clients, all their RSUs vest and all their bonuses come in. So that's when it's cash flow heavy, and people are like, all right, I've got all this cash. What are we doing with it? I know we got a plan in place, but can we change that plan? I'm like, no.
Of course.
It's great in theory, but once that cash hits, people like to make different decisions. So it's just a busy time of having these conversations with people and making sure that everyone's still on the same page, because in the summer, it's quiet and people like to have those theoretical conversations. When that cash hits, it's like, it's here.
It's very different once it hits versus when it's not there.
Mm-hmm. Yeah. So they're fun conversations. It's just making sure that, okay, there's a plan in place. Let's follow it. Let's follow your tax return. Let's keep going.
Yeah.
But it's a good time.
That's like half our job, I swear, is keeping them on track and reminding them. And again, my clients have deviated. They've come with, but they better come with why they want to deviate. Mm-hmm. And it better be strong.
Thank you for listening to this episode of Playbook of the Wealthy. If you want to listen to us while you're walking the dog, we're on every podcast platform that's out there. Don't quote me on that. If you want to watch us on video when you get home from walking the dog, we're on YouTube, Spotify, LinkedIn, and Instagram. If you want to send us a question to get featured on the podcast, you got to go to our website first, playbookotw.com. From there, you can send us a question. It is hello@playbookotw.com, and we'll see you next time.
Toodles! I love your questions. Keep sending them. How are you more cold than I am? I have the worst circulation ever.
Stop bragging about it. Jeez. It's not a competition here.
Did you have to warm up the car? Is that why? Like, what's your car's name?
I'm not having this conversation now if you can't remember the name of the car that drives you around. It's just
rude.
You
named him?
It's rude.
What's his name?
I haven't. Stop criticizing me for getting cold. I can't control it.
Have you named your car?
No.
You haven't named him?
Luke, we're about 30 minutes away from me just walking out, so...
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.